Bill Baruch, you trade bond futures. Let's talk about this Ackman call on essentially what will be rising interest rates on the long end of the curve, at least for the medium term, maybe short to medium term.
Well, look at the price action this week. I mean, it's an easy one to kind of jump on. I mean, the bond market has really collapsed. Now, he's not new to this trade. I mean, there is a short position, and so the CFTC, which runs the futures market, they regulate it. So they do what's called a commitment of traders, put it out every Friday for the prior week. It's a 10 to 1 short position right now, net short position, outpacing the longs. So he's getting into a trade that's really already short. I think the big thing to really take away from this week as well is what's going on in the deficit spending. We saw the Fitch obviously downgraded, but when the Congress raised their expectation of deficit from 750 million basically to 750 billion to $1 trillion, that difference, that increase of 250 billion was larger than any annual deficit. This is a quarter move, any annual deficit going back to 2003. So this is larger. So they're going to have to print this money. They're going to be issuing these bonds. So, yeah, I'm looking back at July as well. So you had a big fallout in the bond market in July, and the market really prices this stuff in fairly quickly. So my question right here, with Ackman's jumping on a crowded trade in a market that really already is pricing in this issuance that's now coming down the pipeline. And so, I wonder what the data is. I mean, if the data doesn't come in hot and we see wage growth cool tomorrow, the bond market's going to rally in his face. So I don't know if I really love it here.
I would say, Jim, I mean, just from a conceptual standpoint.